Good evening. Good evening and welcome. I'm Heather Russell, Executive Vice President and Chief Legal Officer of TransUnion. I also have the privilege of serving on the Executive Committee for the Board of Directors here at the Chicago Council on Global Affairs. So happy to have you all here with us in person and online. You know, it's an especially interesting moment to be talking about the economy. On one hand, inflation has come down significantly from its peak. Unemployment remains relatively low, and the economy has continued to grow. And on the other hand, Americans are still feeling the strain of higher prices. Businesses are navigating uncertainty around trade and tariffs. Rapid advances in technology are reshaping industries faster than policymakers can respond. And at the center of many of these conversations is, of course, the Federal Reserve. The Fed's decisions influence everything from borrowing costs and business investment to hiring, consumer spending, and financial markets. But understanding the economy today requires looking beyond interest rates alone. It also means considering how global developments, technological change, and regional economic conditions shape the challenges facing policymakers. Those broader economic forces are reflected in communities across the country, and few places illustrate them better than Chicago. As one of the nation's leading centers of finance, manufacturing, transportation, and innovation, this city offers a unique perspective on how businesses and households are responding to a rapidly changing economic landscape. We are extremely honored to have with us tonight Austan Goolsbee, the President and CEO of the Federal Reserve Bank of Chicago. President Goolsbee's leadership and expertise have helped shape both regional and national economic policy. And we're looking forward to that continuing under new Fed Chair Kevin Warsh, who President Goolsbee recently characterized as a foxhole buddy from his years during the financial crisis. Joining him in conversation is Brent Neiman, the Edward Eagle Brown Professor of Economics at the University of Chicago, Booth School of Business, whose work on international economics and public policy makes him an ideal moderator for tonight's discussion. Please join me in welcoming President Goolsbee and Professor Neiman to the stage.
All right. Well, welcome to everyone. Thank you for being here. And thank you to Heather for that terrific introduction. My name is Brent Neiman. I'm the Edward Eagle Brown Professor of Economics at Chicago Booth at the University of Chicago. And I'm a former emerging leader here at the Chicago Council of Global Affairs, where I also now sit as a board member and chair our Global Economy Roundtable
He's
series.
emerged.
I've emerged, that's right. And couldn't be happier and more honored than to be on stage tonight with a former colleague of mine, Austan Goolsbee, who is currently the president and CEO of the Federal Reserve Bank of Chicago, which does many things. It conducts economic research, it monitors regional economic conditions, it supervises and regulates banks and bank organizations, and provides financial services to banks and the U.S. government. Austan also currently serves on the Federal Open Market Committee, which is the part of the Fed that makes interest rate policy, that sets interest rates. Now, prior to becoming president of the Chicago Fed, Austan was the Robert P. Gwynn Professor of Economics at Chicago Booth, which he joined in the faculty in 1995. He served also as a member and then chairman of the Council of Economic Advisors from 2009 through 2011, and was a member of President Obama's cabinet. So for tonight, we're going to start with a discussion. I'll ask Austan some questions. We'll have some back and forth. And after that, we're going to do a Q&A with the audience. All audience questions for tonight's program, whether you're watching remotely or whether you're here in the live audience, all questions should be submitted, please, through an online interface. And the address for that is ccga.live. So if you want to submit a question, go to ccga.live. and that will then compile. And when we get there, I'll read through some of those questions. Lastly, I just want to remind everyone that today's program is on the record, and any views by speakers that we host here at the council are their own views and don't necessarily reflect any institutional positions. With that, let's get started and welcome Austan.
Yeah, Brent, my claim to fame is I was right above the stairwell from Brent. You go down the stairwell, 3 offices in there, that's where he was. We almost wrote a paper together, remember that? It just didn't work. We had the data, we crunched it, it just didn't.
It was close.
It was close.
There's still time,
Yeah.
so, hopefully soon enough. So, okay, thanks for being here, Austan. I want to ask you a bunch of questions about the current state of the world, but before we get there, can we kind of zoom out and essentially just sort of set the stage? If you could give us a bit of a Fed 101. What's monetary policy? What's fiscal policy? What does the Fed do and not do? And how does that manifest in your life?
Okay. So monetary policy is the control of one interest rate, basically. But the Federal Reserve System and the Federal Open Market Committee meet every 6 weeks in Washington. They vote on the federal funds rate, but it's basically about short-run interest rates. And economists think of it as the divine coincidence that the law gives the Fed the job to do 2 things when setting that interest rate: maximize employment, stabilize prices, which we have interpreted to mean get inflation to 2%. The divine coincidence is that most of the time, when you're trying to, if you're aiming to maximize employment, it's the times when unemployment is high, inflation is low. And usually in the times when inflation is high, unemployment is low, and they're overheating. And it kind of works because the most cyclically sensitive parts of the economy are also the most interest rate sensitive parts. So if it looks like things are overheating and then you raise the interest rate, kind of cools it down and you get inflation down. If it looks like you're teetering on the edge of recession, you lower the interest rate, you get more investment, you get more construction, you get more consumer durables purchase. That's what the Fed does on monetary policy. And that gets most of the public attention. But Brent was right to raise, there are other functions of the Fed. One is it's the lender of last resort. When everything goes wrong, the financial institutions can come to the discount window if they have good collateral and get us through a crisis, the various crises. We run a major portion of the payments system, the plumbing that underlies the financial system in the United States, wire transfers, ACH, direct deposit. The majority of that is going over the Fed rails. And then we're kind of as part of that, we're a bank to banks. And all the cash in the entire economy is printed by the Bureau of Engraving and Printing, but is distributed through the Feds. And we've got many tens of billions of dollars of cash sitting in the vaults down underneath in the way basement. And there's armored trucks coming in every day, and we're running it through machines and pulling out the counterfeit and the whole bit. And then we're major parts of our communities. When they set up the Federal Reserve Act in 1913, they were suspicious, as people are today, about the federal government controlling the entire monetary system of the United States with no input from the rest of the country. So they built 12 reserve banks from out in the heartland. And at that time, we were the West. I don't know. And so we come there, we're supposed to represent our regions, the 7th district, widely acknowledged the greatest of all the districts, but we're most of Michigan, Indiana, Illinois, Wisconsin, Iowa, 90% of that economy, kind of heart of the Midwest. And we play a key role in just getting out, talking to people, and hearing from them.
And actually, before moving on, are there differences between the different Federal Reserve banks that we should think about above and beyond just representing different regions? Do you do something different from the president of other Feds?
A little bit. I mean, it's an interesting question. So that heart of the Midwest, we're the most manufacturing intensive of all the districts and by far the most automobile manufacturing intensive. So we'll have some industry expertise for our regions, but also New York and Chicago, because we have a lot of the big derivatives trading, the designated financial market utilities, DFMUs, they call them. There are 7 that have been designated as systemically important for the economy. 3 of them are in Chicago, 4 of them are in New York. So our 2 banks have a big finance component that's distinctive.
Got it.
In Dallas, they have a famous energy center because they're the biggest oil producer. So there are some specialties, but for the most part, as you know, most of the economy is basically macro in every state. We are more manufacturing intensive than other districts, but it's still the case that most of the jobs in our district are services, just like they are everywhere else. And mostly when you see the national unemployment rate, that tells you most of what you want to know.
All right. And actually sticking, last question on the Fed 101 front. I know better. I know not to ask you questions about fiscal policy, the other kind of policy.
Yeah, you asked that before.
But people might ask.
Fiscal policy is every other thing. Okay, so the Fed is this part of the universe. But in that part of the universe, it makes a pretty big difference. And we're not the bad guys. We're the guardians of the galaxy of that part of the universe. Everything else in our world is fiscal policy. For sure, taxes and deficits and debt and trade policy and all of the things that are interesting and make life worth living. That's not monetary policy, but that's okay. You know, as I always joke, and you may have heard me say before, our motto in the Midwest is there's no bad weather, there's only bad clothing. And you just tell us what the conditions and we'll pick the correct jacket. And fiscal policy, in a way, are the conditions. With the law says if it affects employment or prices, we have to think about it. But I try to resist. In my world before I was ever at the Fed, I did a lot of my research on taxes and government policy, but I'm out of that business. And so what do you think of the tax bill? That's not our thing.
All right. So we'll make sure to filter those questions out if any come. So, all right. The Fed's got a new chair. So it was.
Fed has a new chairman.
Was Jerome Powell. Now it's Kevin Warsh. He oversaw his first FOMC meeting, this recent meeting in June. Where
I love that. He oversat. I've oversat many things. Yeah, but this was his first meeting. Yeah, that was exciting.
This was his first meeting. Yeah. It was exciting. For those of us, so interest rates were held steady, and the committee about half set expectations. They said that they thought that over the next year there might be rate hikes, or the expected rate hikes. But leaving aside the actual interest rate decisions, is there anything that you can tell us about how you think the Fed might have a different style or leadership norms or operate differently under Warsh than was the case under Powell?
Some of the most obvious. Now, the rules of the committee are everybody's only supposed to speak for themselves, not speak for the committee, not speak for anyone else. And they're very hush-hush and secretive, as you might imagine, of what happens in the meeting. There's a federal blackout period surrounding the meeting. And they drop the shades so nobody can see in the windows. And it's like the Situation Room. You got to leave all devices outside of there. So I'm not going to tell you what he said, but I will say it's obvious from the statement. Every time there's a decision, comes with a statement. And the statement this time was dramatically shorter and did not involve what we call forward guidance. So in the statements before Chairman Warsh, there would be the committee feels that it cannot cut rates until X thing happens, that it would kind of make a sort of a semi-forecast of what's on people's mind. Chairman Warsh has never been a public fan of forward guidance, and he scaled the statement way down. And that sparse statement that is purged of forward guidance has a bunch of the financial analysts like, what does this mean? We're used to having more information. I'm sympathetic and was sympathetic before. I have always been uneasy with the use of forward guidance on a routine basis in the statement. I kind of don't like, I think.
And why?
A couple of reasons. One, there are moments when forward guidance, no question, is useful. Like when we're hitting the zero lower bound and the rate is already to zero, and now what do you do? Your options in monetary policy are quite limited. So when that happened, that's when they started creating forward guidance, that maybe we could get other rates to go down if we start saying we don't think we're even going to contemplate raising the rates above zero until we see XYZ happen. I described the purging of the statement a little bit like a caffeine cleanse, that even if you like forward guidance, it still makes the forward guidance more effective if you're not drinking 3 cups a day every day. And that we kind of got into an element like that. The other more technical thing that made and makes me uncomfortable with forward guidance is there is a sentiment that goes, let's not surprise anybody. The point of forward guidance is let the world understand what the reaction function is so nobody's surprised. Now, the problem with that is then there's a sentiment, well, we can't do anything until, if we have the forward guidance, we got to go at least another meeting and take the forward guidance out before we actually do it. And if you get on that, you can just make yourself slow-footed and move too late. All of that said, I do think there's an element of any time the Fed says something that is a prediction, that's a speculation, that ends up not being true. And it might not be your fault. It might be something happened. There was a war you couldn't have expected. But I think any time you hear the Fed officially making a prediction that doesn't turn true, the credibility takes a ding. And that might not be a big ding, but that's what I don't like.
Okay, thanks.
So that's pretty different. It feels like under Chairman Warsh, at the least.
No more forward guidance, at least so far. Okay. And you just mentioned there could be a war. So it's a natural transition. Yeah. So, a few weeks ago, you spoke about seeing evidence of the impact of the war on inflation. And certainly it's a major part of 2-3 weeks ago, almost everyone's forecasts on the path of inflation. And now, certainly there's, I'd say, a good chance that fighting and that the situation is winding down. And I wonder if you could tell us a little bit about how developments over the last week or two have changed your thinking on the path of inflation, directly the impact from the war.
You and this audience are far more experts on global affairs than I am. My understanding was largely rooted in financial markets, that they were predicting the price of oil would come down pretty significantly on a rapid basis if you looked at futures markets. Then as the war continued, they still kept predicting it will fall rapidly. It's just that the base kept inching its way up. So when the thing began, they said, the price will be, it might be whatever, $90 a barrel now, but it will be 70 by September. Then it was, well, it might be 100 now, but it will be 80 by September. If we are now getting on the curve where things might start coming down, I think that's great. You would start to see it in headline inflation. We tend to look more at core inflation. We're trying to get the through line, not the variability. So
Can you cover the difference between headline
the
and core?
difference between headline and core inflation is simply one of them ignores food inflation and energy inflation, which then my mom goes crazy. What do you mean you ignore food inflation and energy inflation? But it's true. We mostly do because those ones are up and they're down and there's massive variability. And core inflation does give you a little better sense of what the through line is. So we collectively as economists, and me personally, I didn't over index on headline inflation going up as rapidly as it did because of oil prices. But I was a little concerned that you started to see, even ignoring just the direct oil price, it was getting into core inflation in a variety of ways. And if that continued, that would be a bit of a mess. If we cease the hostilities, I'm no expert on energy production, but my understanding is that even if everything were done today, it's still going to be some time to go fix some of the things that have been blown up and some of the problems. And we still got to resolve some of these. What will be the expense? What will be the transportation expenses coming through the Strait of Hormuz? That said, this could be a nice tailwind for the economy in the short run. In the same way headline inflation soared, headline inflation could come way down. If it were big enough, price impact could even be negative. But I just caution everybody. I caution them on the way up. Hey, don't overreact. And I'm cautioning you on the way down. Don't overreact either. What's the most important thing is trying to get the through line of inflation. And we first had tariffs. I felt we've been above the 2% target for a long time, but we were making some pretty substantial progress. Then we hit a tariff shock, which is supposed to be temporary on inflation. One-time increase, yes, but not keep increasing. But before that went away, then we got the oil. It's also supposed to go away. If we see both of those going away, that could be a fun ride on the roller coaster. But there's been a kind of a disturbingly high component of services inflation, which isn't really from oil prices. It isn't really from tariffs. Why is it high? Historically, that's a pretty persistent type of inflation. So I do think it's worth keeping an eye on that.
So you talked about oil price shock going away and tariffs potentially going away. Is that your assessment from the data, that it looks like the implications from the 2025 tariffs, in fact, are going away in terms of the growth of prices?
I hope so. It's been more persistent, that it was slower starting and has proved more persistent than people anticipated when it first began. I'm hesitating. Now I'm sweating it because Brent did all the, if I'm like, you know what people thought before, Brent's going to be like, that's not what I thought. I published a paper on that. But I think it's pretty fair to characterize the run-up of prices was delayed more than we thought. And now it's been more persistent than we thought. And public forecasts have had this feature that inflation was supposed to peak in the fourth quarter of last year. Then it was going to peak in the first quarter of this year. Then it was to peak in the second quarter of this year. And it's just kind of still been floating along up there. But if you look at goods inflation, that is the thing that went way up with the tariffs. And you have seen a little bit of progress now starting. 1 month is no months. It certainly doesn't make a trend, but if we got more months like the CPI we just got, which showed goods inflation going back to mild deflation, which is what it was pre-COVID, that would be a great sign.
Got it. All right, we'll move a little bit away then from the international supply shocks and more toward kind of domestic macro. think we should talk about labor markets.
Okay.
So unemployment rate is pretty low by historical standards at 4.3%. But there's lots of different ways you can measure unemployment. One thing, the denominator of that 4.3 unemployment rate is the labor force. And so if people get frustrated looking for jobs, let's say, or for whatever reason leave the labor force, then it doesn't show up in that unemployment rate. And so there are other measures that look at things like underemployment and get much higher numbers. Across all these kind of measures, would be interested in hearing, what do you look for? What's your preferred way to gauge what's going on?
You're getting a master class just in the questions here. That's exactly how you should think about the labor market. There is an older style of analysis that goes, let's just find what's the best measure and let's key on that. And historically, always the best measure, and it's why CNBC, we get all juiced up on Jobs Day, is how many jobs were created this month on net. That was the most powerful number. Okay, the only problem is when you get into a period where immigration, there are big question marks, population growth, there are big question marks, labor force participation, a bunch of question marks. Those things affect that monthly number in a way that's not observed until much later. And now that doesn't really tell you how much slack there is in the labor market, or like, where are you in the business cycle? And I was saying this I started in the Fed at the beginning of 2023. Through 2023 and 2024, we were having giant monthly job creation numbers. And there were people from this old style who were like, with numbers like that, inflation is about to come roaring back. With the job market is too tight. And I said, we don't know that, because a bunch of stuff is happening with population. And I repeat it again. Now we went through a period where we were getting a bunch of low monthly numbers. And the same folks said, that means the recession's about to begin. And I cautioned again, don't index on a number where there are a bunch of question marks. Take a portfolio. I found that during this period, a better indicator of labor market slack was to take, I started to call them the four horsemen of the truth. They are the rate-based measures: the unemployment rate, the vacancy rate, the layoff rate, and the hiring rate. Those are four good ones. They don't agree, unfortunately, but they are all very stable. The labor market has been remarkably stable for more than a year. The weird thing, and if you have a college-age kid, you know what I'm about to say. The hiring rate is extremely low. Normally, with a hiring rate this low, you're in the depths of a recession. It's very hard. And if the hiring rate is low, who's it going to affect? It's going to affect new college graduates, because they're a disproportionately high share of new hires. Okay, but the layoff rate is also extremely low. As low, if I just showed you the layoff rate, you'd be like, wow, you must be at the peak of a big boom. And it's extremely weird that the layoff rate and the hiring rate would both be really low. That's the high, low, higher, low, fire environment. I think that's from business uncertainty, that businesses are like, we just don't know what the rules are going to be. So we're not going to get rid of any of these people, but we're not going to bring on any new people. We're just going to sit and wait.
You said uncertainty on the rules?
Yeah, some on rules, some on tariffs, some on, there's just, in a lot of spaces, a lot of uncertainty. If I'm right about that, it feels like a lot of these uncertainties continue. So we might see that environment for a while, but I could be wrong. It's not like the economists have this all sorted out. We're all debating this question. I do think, though, that the job market, in my mind, is stable without being good. It's okay. It's not changing. Even the low hiring rate hasn't gone down. It's been flat. The low layoffs rate hasn't gone up. It's been flat. The unemployment rate, basically flat. So I think the job market is pretty stable.
And just to make sure I got it, the idea is if there's a lot of uncertainty, you might sort of wait and see. You just sort of hold off on some new decision.
Yeah, you don't
So we're not
decide to get rid of people.
We're not firing.
You don't decide to bring on new people. Now, in different sectors, of course, this isn't true. I have a son who's a coder. Look, there are layoffs in some sectors, but in the overall economy, I think it's been pretty stable and characterized like that.
All right, then you just mentioned that your son's a coder, which certainly brings us, I think, naturally to AI.
Yeah.
And there's a ton of excitement about AI. There's a ton of investment that's pouring into AI. But what I assume, and you tell me, but I assume the most important thing about AI from the perspective of monetary policy in the Fed, or one of the most important things is, does it increase productivity? Does it actually produce that economic return? And I'd like to hear what you're seeing on that question so far.
Okay, so the productivity growth rate, economists love productivity growth. We love to talk about it. It's probably the most talked about and important thing to us that the public, if they say, what's one number that nobody pays attention to that they should? This is the number. This is the number you should pay attention to. The prospect that some technology would raise the productivity growth rate is wonderful. That's what made us the richest major economy in the world, was productivity growth. It will make us rich again. It will come, if it happens extremely rapidly, it will come with dislocations for sure. But overall, our gut tells us fast productivity growth is awesome. There is a sense in which that you assumed that's the most important thing to the Fed. Maybe. But remember, the Fed, we're about the business cycle. We're about the short run and stabilization. And a lot of this productivity, I'm not saying it is pie in the sky, but is long run in nature. It's like, hey, over the next 20 years, productivity growth is going to change. We've seen in the last 2.5 years, productivity growth is a fair bit higher, 75 basis points, 1 full percentage point higher than kind of the trend was before COVID. I don't know if you can attribute it literally to AI, because AI adoption hasn't been fast enough or as pervasive enough to cause it. But at the early end of this, I gave a speech out at Stanford saying it looks like it might be tech related as opposed to a one-time bump up in productivity that came out of COVID. Like, we figured out that hybrid work is more productive than non-hybrid work. That'd be a one-time increase. I said, look, the increase in the growth rate looks like it's correlated with the use of these new technologies. If so, big general purpose technologies take time to diffuse their way through the economy, so we might have an increase in productivity growth, which in theory would mean lower inflation for a given growth rate. But, and here's the part where I want to caution everybody of what does it mean for the Fed. If you knew, it makes a huge difference. Is this productivity growth expected so everybody understands that it's coming and we're going to be rich when it arrives? Or is it landing on us and we didn't expect it? Okay, what's happened so far has landed on us and we didn't expect it. But now this is the most expected increase in productivity growth that of our lifetimes, at least, maybe ever. And the problem with expected productivity growth is that's an increase in your wealth today. If I tell you you're about in 2 years from now, you're going to get a big pay increase, you want to spread that spending out. And so you start spending now. And if you have IPOs that are worth $1 trillion, and suddenly everybody is rich who works at these companies and goes out and starts buying stuff, or data centers have massive investments planning on these high equity valuations. You can easily overheat the economy in the short run before the magic of the productivity has arrived. So I do think it matters a lot to the Fed, not just whether it increases productivity, but whether it's shifting activity into the present and overheating this economy. And you're now seeing some articles about that.
Is there like a historical precedent or some example that you use to help you think this through, or is it really something novel that doesn't have natural?
There's a loose parallel, kind of like a cousin, but certainly not an identical twin, at the end of the 90s, where there's a big run up in valuations. There's a big increase in use of the internet. You see an increase in the productivity growth. A lot of people remember Alan Greenspan, the Fed chair at the time, arguing we don't have to raise interest rates because productivity growth will lower inflation and we can run the economy hotter. That is kind of a parallel, but the parallel goes even farther, and I hope that people will remember it came in two parts. That was circa 1996, and it hadn't shown up yet in the data. Alan Greenspan deduced that there must be an increase in productivity growth happening because he said corporate profits are going way up, the unemployment rate is falling, and there's no inflation. So he said it must be that productivity growth is increasing, and we just don't know that yet. And he was right.
This was the famous conundrum, right?
That was the famous conundrum. Okay, but by 1999, now the data has proven him right, and it's increasing. And then the Fed actually starts raising the interest rates very rapidly and significantly on the grounds that, whoa, wait a minute, this is overheating the economy. And there are dangers of inflation, and there are dangers if the valuations get too out of control. So that is a bit of a historical parallel. And there are many historical parallels to general purpose technologies, electricity and telephones and combustion engines and computers and the internet, et cetera. I would characterize one of the lessons of those is takes a lot longer for that to spread throughout the entire economy than you would think. Certainly than the biggest promoters of AI are alleging. They're kind of like, within 2 years, every job is going to be gone and AI will be running everything. It might, maybe, but if you look at electricity, if you look at phones, if you look at engines, you look at a bunch of things, it took much longer.
Yeah. Okay. So we've only got a few minutes left. A couple quick questions, but one is you.
He's being polite. He's like, you need to be more succinct.
No. We got time here, but
I can do that.
You said that it was a consensus view that this district, the Chicago Fed district, was the best district, the greatest district.
Yes.
I'm not going to argue with that, but it does have quite a lot of heterogeneity. There's agriculture, there's manufacturing, there's financial services. What can you tell us about the current state of affairs of the district's economy, perhaps relative to the rest of the country?
Look, as everybody in this room knows, a lot of the Midwest have been dealing with relative population decline. Sometimes absolute population decline, but at the least growing slower than in other parts of the country. And our friend, we have a joint friend, Ed Glazer, who's one of the, if not the leading urban economist of cities anywhere. And he has this old paper that says, why do some places grow and some places don't? And he kind of says 3 factors are the most important. One, if you look at places that are perennially growing the most, one is since the invention of air conditioning, what's the temperature in January? And the Sun Belt has done better. People like moving to warm places when the summer is not unbearable because they crank up the air conditioning. 2, what's the skill base of the workforce? And 3, how diversified is the industrial base of the area. Those three things are very correlated. In the Midwest, it's certainly not a monolith. You've seen some of the metro areas have done better than others. Where you've seen the biggest population declines have been in places where the average education level, skill base is relatively lower, and places that are more one company, one industry towns, that they've suffered more. Agriculture and manufacturing have also had long run declines in the share of the workforce that are in those because there's productivity growth. And as the price of cars in real terms goes down, if you cut the price of cars in half, each person doesn't buy two cars. They just spend less of their income on cars. So we have dealt with that some too. Mostly the Midwest has behaved as has the macro economy, but we are dealing with this population decline.
Yeah. Okay. So in the last 2 minutes, and then we'll jump into questions, I just wanted to ask, kind of very broad based. You've now spent 3.5 years as the president of the Chicago Fed through a very turbulent time. So hopefully less turbulence coming up. But nonetheless, when you look ahead, can you tell us one of the things that you feel most, kind of cautious or nervous even about, and one of the things that gives you the most confidence about the economy?
Yeah, it was when my last stint in government was at the first term of the Obama administration. It was a financial crisis and everything is going wrong. And then they come over the Fed. I'm like Pigpen in the Peanuts cartoon. I'm starting to think maybe it's me. So worries and hopes. In the hopes, it is this productivity growth thing. We've seen it. It's up. If productivity growth is higher, it means our standard of living is going to go up. Our wages can rise faster without generating inflation, and that will be fabulous. We'll have to figure out by the speed at which that takes place. We're going to have to manage what dislocations. But overall, that still makes me quite optimistic. And the continued entrepreneurial character of the United States as an economy is worth a ton. There are if you ever find yourself, oh, woe is us, go talk to some people in other economies. Anybody would happily trade places with us or with you for that reason. The worrisome stuff, I'll not think of it in the grand long-term sense of like, are we all doomed? But instead, in the Fed sense, it is that inflation proves substantially more persistent than we are currently forecasting. We just went through that. We just had a period. I wasn't there, so don't blame me. But the Fed made a mistake thinking inflation is just going to go away. Hey, it's just from the supply chain. The supply chain will just fix itself quickly. And it didn't fix quickly. It took a lot longer than they thought. That is entirely possible. We need to be extremely vigilant about that because I think the very fact that people already got burned once makes them much more prone to declare, what's the opposite of declaring victory? Declaring loss. To declare, you've lost. This thing is screwed up, and factoring that into, in our language, that it would factor into the inflation expectations. If people go down when they're negotiating their wages and they're counting in their head, I think inflation's going to be 7% next year, so I'm going to need 8% wage increase. And the employers are like, oh my goodness, if we got 8% wage increases, we're going to have to raise prices even more. That kind of a spiral, if we get on that, is really, really difficult to get. It's self-fulfilling and it's really difficult to get out of.
All right. Okay. You mocked how didactic some of my questions were. You should see some of these that were...
I didn't say didactic. I said it was a master class.
Well, all right. I'll take
to talk about a glass half empty. Well, I was like giving you a compliment. He's like, "Oh, you're saying I'm boring." Yeah.
I just want to get you ready, but no.
Yeah.
All right. Well,
we got some questions.
We'll keep this one simpler, but
We're
the questions.
both professors. We could filibuster the whole
we can
night
handle
if
it.
there's no questions. We got some.
All right. Well, the first one I want to ask, someone asked, I think very helpfully about leverage and how downturns often occur when there's a shock combined with leverage. If you could, one, just kind of explain that for people that don't know, and two, talk about what you're seeing in terms of leverage and private credit.
Okay, this is a very important point. I wouldn't characterize it that downturns come from shocks plus leverage. Financial crises and much bigger shocks happen when you have leverage. So if you look back at subprime mortgages, the losses in subprime mortgages were a certain size. But if you borrow against it, then when the value of that asset goes down, now everybody's got to get in a fire sale. They're having these margin calls. Hey, where's the money? And that thing can spiral into financial crises. That's certainly what happened in the Great Depression. There was a big initial shock, but that leverage spiraled into a thing that did not fix itself. The normal self-correcting mechanisms kind of fall apart. That happened in the 2008 financial crisis. The good news, if you want to think of it that way, is if you're afraid of bubbles, this looks more like if not purely equity bubble, it's much more equity and less leveraged overall than 1929, than 2008. It looks more like the 1990s bubble in the internet, if you think that's a bubble, which was mostly equity. If something like that goes down, it doesn't make life fun. A lot of people lose a lot of money, but it doesn't turn into a financial crisis. So I'm hopeful that that's true. At the same time, there are frothy elements, and you're starting to see stories about private credit, stories about debt financing of data centers, and we're going to want to watch the amount of leverage on that grounds.
Yeah. Maybe staying kind of on this thread, there are some questions on other places that might pose financial stability risks, plausibly could, things like cryptocurrency. And wonder if you could talk a little bit on what the Fed's role is with respect to those kinds of issues, regulation, financial stability. What's your role?
Okay. The Fed system is a financial regulator. The reserve banks don't set the policy. The regulatory policies are set in Washington by the Board of Governors of the Fed. We employ most of the actual bank supervisors and the people who go down and check to make sure that the banks are following the rules. We are the operational wing, but we aren't the determiners of the policy. There's been a rise of fintechs and financial firms that are non-banks. That's been happening for many decades. The rise of money market funds, the rise of a whole bunch of non-bank financial institutions. The 2008 crisis was not exclusively, but was heavily concentrated in non-bank financial institutions. So whenever you see rapidly rising non-bank financial institutions where you're not totally familiar, are they being regulated?
And these include hedge funds, insurance funds.
Yeah, they might be hedge funds and private credit, and the farther away from literal banking it is, the less information we have about it. And so we don't know, but my rule, I always say the first rule of financial accounting is nobody hides good news. So if you say, well, I wonder how much inherent problem there is in X business, if they're not out telling you, no, there's not a problem, look at the numbers, that's not a great sign, because if you have good news, you share it. That said, we learned in 2008 the hard way that one of the key lessons is for financial crises, as opposed to just the speculative investors lost their money, what matters is how connected you are to the rest of the financial system. Right now, a lot of these, to my mind, are not super integrated into the full financial system. And the overall level of leverage isn't as high as it has been in some other times. So that's more comforting on the financial crisis front.
Okay, great. A few questions about housing. Asking about your views on, the supply of housing, or your observation on the affordability of housing, and a question: can the Fed do anything to fix what some have referred to as a housing crisis?
As the rent is too damn high problem. Okay, the Fed doesn't control the mortgage rate. Let me just start with that. I told you from the beginning, we're setting an overnight rate that's kind of like between banks. It does matter, our rate. Mortgages are 30 years long. Okay, so those are the long rates, not the short rates. What the Fed does in the short term does have an influence, but the market determines what those rates are. And you can have circumstances where the Fed cuts the rate, cuts the short-term rate, and the long rate goes up because people think there's going to be more inflation, or the opposite. That said, the following really striking fact of the last several years, if you talk to any young person, new family, starting new family, whatever, they say, geez, my grandpa, he had one income, and it wasn't even that high an income by today's standards. And look at the house that he bought, that like my parents grew up in. I can't even afford a condo. What has happened? If you go plot house price inflation, and we want to be a little careful how we define it. It's not the single price of a single family home, because part of that is an investment, not a price. So we tend to think of it as rental prices, the cost of renting. The cost of living in a space has, in the last couple of years, compared to the price of goods inflation, housing inflation relative to goods inflation, we went through this period coming out of COVID, housing inflation way higher than goods inflation. That's been true for 40 years, okay? If you take housing inflation minus goods inflation, which is actually mild deflation for most of this period on goods, the cost of housing compared to what you buy at Costco has been relative price changing 4+% a year, every single year for 40 years, okay? Now, it doesn't take two Booth professors to tell you that if you compound a thing 4% a year for 40 years, you're going to have a big number. Everybody's not wrong. The relative price of housing is massively more expensive than it ever was when your grandpa was buying a house, or when your parents, or anything. Then the question is why? And I don't totally know. Now, I do think the economist's first answer to first order is not wrong. You want house prices to stop growing this fast, you got to build more houses. And we've went through a period where we did not build houses. Part of that was coming out of the housing bubble popping. There was a widespread perception we built too many houses, and let's not expand people into housing as much. And it takes a long time to build houses. So I think we're still a little bit in the shadow of that. Part of it was in COVID, there was a weird change in demand for space. The price of office space went way down because people aren't coming to downtowns, and the price of residential housing went way up because basically it was just transferring where people were doing the work. So that might have been part of it too. Last 4 or 5 months, you've seen some progress on the housing inflation front. It hasn't been growing as fast as it did pre-COVID or as it did post-COVID. But it's a huge component of the affordability challenge, I think. When people say affordability is killing us, I don't think they're just talking about, well, core inflation's been 3.4%, not 2.0%. I think they're kind of looking and saying, here are some big tentpole goods, housing, college education, financial, the healthcare, a series of things whose relative price has been rising even faster than overall inflation.
Okay. Okay, we're almost out of time, so
Okay.
we're going to ask one last
Speed run.
question.
Yeah.
Don't worry, they're not long, but I'm going to
Okay.
actually merge two questions together.
Okay.
All right, so let me get both out, and then I'll turn it to you. But you have a former student in the audience. In fact, the student claims they've taken your class multiple times. I don't know. And they say that at the time, you were fantastic at explaining Fed policy to students. And they wonder if it's gotten harder or easier to explain Fed policy now that you're actually involved in making it. Another question.
Because I can rail against the idiots at the Fed now. I'd be like, no, it wasn't.
And the other question asks you
Yeah.
to talk about if your view on how Fed policy works has changed since starting to make it. So let's test the first by having you dig into the second.
I learned math as I took the job. I kind of understood decently well what is the monetary policy part of the job. And I will still say going to the first FOMC meeting and everyone since, that is, if you're an econ head, that's just about the coolest room in the whole world. And it's awesome. It's just as awesome as like you want it to be. There's a giant table. The shades come down, all the phones are out, and then they're going to go around the table. And it's like, Jay Powell, what do you think about the economy? Chris, day one is about the economy. Day two is about the rates. And I said, no offense to the Senate, this is the world's greatest deliberative body. And I didn't realize, just from a workforce point of view, how mission-driven the organization is. And from the top level, all the presidents and the governors, geez, they take the job extremely seriously. You're in this room. You're out of the elections business. You're out of every business. You've joined the Night's Watch. You know, if you used to watch Game of Thrones, we're down there thinking about maximizing employment and stabilizing prices, and it's all about what it should be. But now go back. We got 1,700 people at Chicago Fed. These people are believers, and that's been pretty amazing. It's changed a little bit my view of the Fed, to see how much operationally it matters, running the plumbing of the financial system, but also these are public servants of the highest order. So now I feel bad for criticizing them as much as I did. They do an amazing job.
Got it. All right. Terrific. Well, I think we're out of time. Let me say, it was such a bummer to hear that you were leaving Chicago booth, but I'm glad you just went down the road to be the Chicago Fed president. You were fantastic tonight. We all learned a lot. Thank you so much.
Thank you all for coming.